Why don't we take the time now to open up any questions that the audience may have? There's a hand there in the back. Next.
Hi, good afternoon, and thank you for a very informative session. A question is from an investor or an allocator perspective. There's more and more talk, given the correlation amongst quant manager, specifically how they all tend to outperform or underperform at the same time, that really quant should be its own asset class, its own beta, and there's got to be some asset allocation decision being made whether or not to invest in quantitative manager. And I'd be interested in your thoughts as to whether or not you agree with that. And kind of the second part of the question is, are you aware of any research being done trying to identify on an ex-ante basis in which environment quant managers will tend to do well?
Matthew, you've done work in this area, haven't you?
Val seems eager. Let's
I mean, one of the things, studies we did back in '07 during the August Black Swan event was, Goldman Sachs was putting out a most concentrated large cap, long position, short positioning indices, and what we did was we just tried to correlate our returns and also returns of some other quantitative equity strategies out there. And it turns out there was very low correlation early in the year, but for that period in June, July, August, where there was a heightened correlation of the excess returns. And when you dug through the different types of variables, what we saw, it was mostly attributable to valuation. That the quantitative strategies tend to have a valuation bias, and that actually was, pretty much explained a huge portion of the gap. And saying that that probably means that quantitative strategies, if they do have this valuation bias, which is they're searching for mispriced securities, so you always, there should be a bias to look for something cheaper. But that also says that if you are in a junk rally or a rally where stocks with high valuations tend to outperform low valuation stocks, that's probably a headwind for quantitative, from a lot of quantitative strategies.
I am aware that some of my clients actually have been talking about whether or not they shouldn't have a category for their quantitative investors in the same way that they have a category for a value investor or a growth investor. And I think that's as much around the playing field that quantitative managers define for themselves and that their clients expect for them as it is anything else. Because if you are a quantitative manager, you are generally held to the standard of or assumed to be holding a large number of securities, to have certain tracking error targets, to either be sector neutral, size neutral, and so to then put those managers and compare them to a manager whose mandate is go anywhere, right? Whatever, any country, any size, any category, doesn't really set up the correct apples to apples comparison. So a lot of my clients have said that to them it makes sense to look at their quant managers together and evaluate how good or bad they are in that context.
I was just going to add that, I mentioned something about Matthew's work before about how it was 6 years in a row with all value. If some of that work was done again, maybe it wouldn't be all quite the same conclusions. But just one other comment is when I've seen that that question be asked before, I guess the assumption is that fundamental managers are not correlated at all. And Savita Subramanian and Merrill has done some work where I think the average quant manager is correlated about 0.45, and the average fundamental manager is correlated 0.35. So it's not, I guess I would not reach conclusions based on a difference of correlation of 0.1 on that topic. I think the other, there are other things that would weigh more heavily in that decision process than just the correlations.
Yes.
How much time for one more question?
Thank you. I'd like this for each one of the members of the panel.
how much do you feel the application of quantitative tools contributed to the diminution of buy and hold as a strategy, and is buy and hold dead?
Over what time frame?
We're all dead over a time frame, but thank you, Maynard Keynes. One market cycle, that would be good. One market cycle would be fine.
I think that what we do is, our models, we tend to want to hold a stock. We have high net worth clients and a lot of tax sensitivity, so, in our models, we're looking for longer duration factors. There'll be valuation factors, of course, in there, as well as, fundamental factors for a company. And the idea is that we do want to hold a stock long, but if it gets to a point where it's keeps beating expectations and the valuation goes up, we have a discipline that if it's too expensive and it's starting to show wear and tear that the company can't keep beating expectations out there, that stock will be dropped from the portfolio. But our intent is anytime we're going into a stock that we are looking to hold it at least 12 months, and if the story continues to be good, then it will be the buy and hold. But that's companies get go through their own cycles, and there are periods when they do well, and there are periods maybe they don't do as well.
Matthew, did you want to add something in a minute or two here to that question?
I'll just take one thing. I've never really, in some ways, understood buy and hold. In some ways, it's like, what's the difference between being early and being wrong? There isn't any, right? And so, on the other hand, what you're really asking in some ways is almost as markets become more efficient, right? Because you need to have a sell discipline inherent in any model, and and understand when you're wrong and get out of it, and when your price is being reached, then you should also get out of that. And if markets become just a lot more efficient over time, well, then you would naturally see, a devolution or kind of a degradation of traditional much more long term buy and hold. I guess I haven't been in this industry all that long, but when I first started, if you would go to people and tell them that you had a signal that was going to trade, and required turnover of 100% every 3 months, you would probably get laughed out of the room. That would be much too high. Now that's almost considered on the longer side of things for a lot of people that I'm talking to, and people are much more willing to hear signals that hold for 2-3 weeks, and so I think there has been all seriousness aside, right, a kind of a much more willingness of people to explore much shorter term alpha type strategies, and and I think that's partly due to the fact that in general, right, short-term trends notwithstanding, that you have seen liquidity in general become, much greater in the market, and you can trade things a lot easier and cheaper than you were able to 10, 15 years ago. And so I think that leads to higher turnover strategies being much more profitable than they were.
Thank you all for not a great discussion, but an excellent discussion. We'll break for coffee now, and we'll reconvene at 3:45.